hear me, don't tell me. No, seriously. Tell me if you can hear me loud and clear. I'm coming through to your ears loud and clear. That'll be helpful. I had a bit of trouble with my internet this morning. Fashionably late as always. You can rely on me being a couple minutes late for these. It's always my fault. So just keep that in mind. It's never you, it's me. Today we're going to be talking about investing for kids. We've got Anna Kresina joining us today to talk about her perspective. She's been through the process. She's written books about kids and money and navigating all of that stuff. So we are joined in esteemed company today, not to mention everyone that's already told us how you're investing. Owen, you've said, great name, Owen. You've said, I've always invested for myself using proceeds for their education and other needs seems less complicated. Jane says, you're going well. That's good. Looking forward to today's session as we only have a bank account set up at this stage, but would like to understand more about kids share investing. Um, Samantha says, was a savings account, now VDHG. Wonderful. Graham, I invest for my daughter using Superhero. I use a mix of Australian broad-based ETFs and some US growth slash hyper growth names. Graham's amping it up a bit. That's good. JJ, small portfolio for the grandchild, ETFs, and a few good shares. PME, that's Pro Medicus. I add money for birthday and Xmas. That's wonderful. Wow, Raoul's in the chat too. Good to see you. Everyone, Paula, Elizabeth, wonderful. Okay, so I'm going to just share some slides, which will include the obligatory, if I can bring this up, here we go. If I can bring up the obligatory disclaimer in just a sec. So investing for kids, we're joined by Anna today. We'll be able to answer some of your questions on the fly, but I've also got heaps for her. Once we say good afternoon to Anna and we say, enjoy the rest of your day, hope you enjoy some sunshine, I'm then going to jump into the more technical areas of this and some of like the more legally financial plannery type areas. So those types of questions about how she approaches it, what she's found doing a lot of research on this topic over the years. So if you haven't already read Anna's book, it's called Kids Ain't Cheap. And it's for anyone. This is a actual book review that I took off Amazon. For anyone trying to find a guidebook to navigate parenthood financially in Australia, it's worth the read, especially for those who are new to the whole childcare system and what to consider if you or your partner is going on parental leave and how that affects your super. So the book is quite broad and it covers a range of topics that parents should know. If you're a grandparent and you're watching this, maybe it's the type of book you buy for the expecting parent, your child, so they can prepare and just understand the system. Basically, everyone that, even financial advisors that I talk to about the childcare system, are just bamboozled. So have a look at the book, pick it up. You can get it on Amazon. There's also a link to Anna's website in the YouTube description. So you'll see that just in the description there. It's annakresina.com. And Anna is also head of product and community at Perla. Now, what's kind of cool here is I just logged in. This is actually the account for my sister. So she has $920. She is a minor under the law, and it's set up using Perla. She's got some Perla cash there. She doesn't have super. I need to put her to work. Get her out in the cornfields making some money so she can get some super paid. But seriously, yeah, she has this account, and I pop some money in every now and again. So we'll go over that a bit later on. But Anna's come straight from the headquarters of Perla HQ. So back to my slides. Every week, every Thursday, it's Rask Invest Live. You know the drill. 12 Eastern time. We go live and then it's available on replay. So if you miss something, if you can't watch the whole show, that's perfectly fine. You can watch it back. Thousands of people watch it back. Not as many people watch it actually live. And that's great because you can still keep in contact with us and comment and leave things for next week. If you haven't already subscribed to Rask on YouTube, you can. It's free. It's fun. And this guy right here approves. He was our first subscriber. I don't know who he is, but he's there. So every day on the YouTube channel, there's a new podcast that releases every single day. So if you like any of the shows, if you like one in particular, you might get a mixture. There's also short form content. Okay, this slide is particularly important for today. I know how much everyone that rocks up every week just loves the disclaimer. It's probably their favorite slide. Everything that we say today is strictly general in nature. We don't know your needs, goals, or objectives. This is particularly important. We don't know your family situation. We don't know how much you're investing for kids or yourself. We don't know what your goals are. Your kid could be 37, or they could be 7. It's up to you to seek the advice of a licensed and trusted financial planner if you do want one-on-one financial advice. I would also consider the key thing for today is if you do plan to invest in a meaningful way and you have kids or grandkids, getting tax advice is really important. So that might be advice on like a family trust or a different type of structure, even if it's just when you do your tax return or your regular check-in with your accountant. Talk to them about your options, talk to them about your plans from a tax perspective. They'll answer those questions. That will be cheaper than going directly to a financial planner. Last week, we had Alex Luck from Everest Wealth Group on the show, and he talked to us about things like family trusts and whether or not they're worth considering. It's kind of a bit of a tricky one if you're just trying to figure this out, but you can go to a financial planner first or an accountant first. Financial planner is more holistic, accountant's tax perspective, but both of them will add value to your life, and an accountant will be cheaper for just a once-off consult. So you could start there and then go to the financial planner. If we do mention things like ETFs and that sort of stuff, it's strictly general, and we're talking about products, so you can go and find the product disclosure statements and TMDs for those particular products. So Anna is a multiple-time author. She's a podcast host, and she's just a delight to chat to. So we will welcome her to the show right now. Anna, how you going?
I'm great. Thanks for having me, Owen.
Thank you. I know you're a fellow Melburnian, so it's good to catch up like this. And the sun is shining, so we won't keep you for too long before you can go out and enjoy it. Now, obviously, you're a parent, Anna. You've written a book, "Kids Ain't Cheap." I might start with a very kind of just a layup question for you, which is, why do you think people should consider investing for kids, or why do they, in your experience?
Yeah, great question. We see the cost of living going up, so it's always really hard for parents to find that money. Expenses are up because you have kids, but it's so crucial to think about the long term. And for most people, it is around school fees, education. What does that look like for your kid? You want to make sure you have money in the future when it costs the most. If you're going to private school, if they're going to go to post-secondary, that costs quite a bit. The other side is that a lot of parents want to set up their kids up with a house in the future. Housing is unaffordable, so if we're thinking about it early, then hopefully we can get them into the market or support them. We see a lot of parents doing this as well. And then the other side is just helping their kids in the future. Maybe your kid is business savvy and you want to support them. Maybe you want to just give them a head start in life. It's possible as well. So a lot of parents are thinking about how do they set their kids up. A lot of that comes down to choice and opportunity. And most of that comes down to having finances in place so that you can support your kids with some of those.
Yeah, it's so true. Everything just gets more expensive with every generation that we go through. I'm going to ask you the next question is, obviously, you're the head of product at Perla, you manage the community, you've got the podcast, books and stuff that you're constantly helping people on social media. What does the data tell you about this particular part of finance? Like, what is it telling you about the family unit or about individuals managing and thinking about that? And if you just surface like the key points, and while you do that, I'm actually going to switch internet connections because everyone's telling me that my audio is breaking up, Anna. So I'm going to do that, and I'll let you go with that question.
Yeah, so a lot of parents do want to think about investing early. And the earlier we can think about it, the better, right? The best time to plant a tree was 100 years ago. The second best time is now. And the same is true with investing. So just even investing $100 a week with a 7% return, that could potentially set your child up if you start at birth by the age of 21 to have $233,000. And a lot of parents look at that number and it seems so unachievable, but when you break it down, they get really excited about investing. So some of the things that I've heard quite a bit is, I've got a newborn kid, I want to start investing for them now. Great time to think about it. In fact, on Perler, one of the youngest minors that we have that are being invested for is under 3 months. So we've got one of the youngest investors, which is fantastic. Meanwhile, we also have people who have larger families. So we have one investor who has 6 minor accounts set up for their kids or their grandkids, and that's really great, thinking about their future as well. And a lot of them are just investing in really regular, broad-based, low cost index funds as well, just to kind of have a very diversified portfolio while investing for the future. Owen is frozen on my end, so I'm just going to keep talking over here. So what I'm seeing quite a bit with the parents that I'm talking to is how do I start investing? What are the options for me? And do small amounts actually pay off in the long run? And like I said, just using an example of $100, that compounding over a long period of time can be really impactful. I said that by the age of 21, that would be 233,000. And for example, if as parents we'd never touch that money for our kids and let that compound, that would be over $1 million at age 40. So those are just some of the things that parents are thinking about. How do we get them get them set up for the future as well? A lot of parents also want to talk about experiences. They want to have experiences with their kids. So maybe it's of the monetary side in terms of the cost of school um, or yeah, school and education or a house, but it's more about wanting to have opportunities with their kids. A lot of parents are investing for the long term because somewhere down the line they want to take a big trip with their family, and that's something that can be really impactful as well. As so we still don't have Owen, but I guess I'll keep going. Some really great things that we have at Perler as well is we have a kids investing hub. Actually, just Google Perler Kids Investing Hub. It'll actually have a bit of a breakdown of the different ways that you can invest for kids on the platform as well. Because a lot of parents want to make the best choice, but they aren't sure of all of the considerations. Tax is a huge one. What platform? How do you want to set up the investments? Those are all considerations when it comes to investing. Owen, I see you're back. I just kept chatting, so
That's
hopefully
good. Thank you
that's
for
all
that.
good. Yeah.
Living out towards the forest has its perks, but it definitely has its downsides. So fingers crossed, everyone's got me for now. And I'm not sure where we got to. And I heard you talking about the Perla Hub for investing for kids, which is fantastic. I did use that in anticipation for today. Um, I asked you a question in the office when I saw you earlier this week. I said, "What are some of the things that parents don't talk enough about?" So we obviously had a conversation about things like childcare and those types of things. Is there anything else, or is that something that people should be more aware of?
Yeah, I think that's a big one, especially for people who are expecting or have young kids. The cost of childcare is a really huge one, but then there's also implications on that, such as tax and income considerations. So, for example, there's a lot of parents I've talked to who wanted to make the best financial decisions, me being one of them. I'm here to own up to my own financial mistakes. Even working in the financial sector, you can make financial mistakes. And one of them was that I wanted to sell some shares to help my family get into a new house. And in doing so, I was in a higher income. Because of that, I wasn't eligible for childcare subsidy and paid parental leave. Now, childcare subsidies have changed the threshold on that, but this is why tax planning ahead of time is really, really important for your family, because even if you think you're making the right choices, it can impact some of the subsidies you get. Secondary to that is often you have a parent going on parental leave, and this is often predominantly the mother. And by going on parental leave, you have less income coming in. You probably aren't contributing to your super. You don't have an employer contributing to your super. So there are some options to look at potential co-contributions, whether you can get government contributions and so forth. So there's a lot in the super side that we could discuss as well. That's not specifically investing for kids, but it is about financial planning holistically as a family.
So it's kind of like more like, yeah, it's the family unit, protecting the family unit. I often liken the analogy and it to be, putting on the safety mask before you put it on your child. On the plane, they always tell you to pop that on first to make sure you're okay. And then you can help the next generation, so to speak. And so that's kind of one of those things that plays into that. I had another one that maybe is for, you could take this as like grandparents or parents, is some of the things that are less obvious. So there was a good question here from Mr. Leftovers about like potential pitfalls about teaching kids about investing too early, like common mistakes. These types of things are things that I often think of, like the obvious ones. But then there's like, you're an expert in this. So what are the things that maybe are less obvious?
Yeah, I think One of the misconceptions is if you're well off or if you financially are doing well, that your kid is going to pick that up from you. And there's the mathematical side, right? Like you can show them the compound interest calculators, you can show them the numbers, and they might get excited about that. But it's really the behavioral side. So, how do we teach them to save well? How do we teach them to spend well?
Mm.
How do we teach them about values, right? Because spending is just as important as saving. It, in fact, is probably more important. Are we spending money on the right things? How far does money get you? And giving them little practical examples where they can actually practice this. For example, if you're going on holidays, give your kid a budget. You have this much money, that's how much you can spend. This kind of helps them work through the whole process, figure out how much money they can save, how much they can spend, what they're willing to spend it on, and whether it's worth it. So actually working through some of those motions, because the behavioral side, the emotional side is far more important than the actual mathematical side.
I think that's so interesting. A friend of mine, Jamie, he's a financial advisor, and he says that there are three things that you can give to children. There's your time, there's your money, and there's obviously your knowledge and those types of things. And the knowledge is something that people often forget. It's like something that you definitely can pass down, and depending on the time that you do that, it will vary. The conversation will change. Um, Bit of an interesting one for you is, I don't know if you've said this when I was just off air briefly, but how do you invest for your family unit? Like, is there a particular way you do it? You don't have to be too specific necessarily, but I'm just curious, just
Yeah, yeah.
big
Great
picture.
question. Because when I first started doing research, there was no information out there about investing for your kids. There was nothing. The only thing I could find was in investment bonds, investing in your own name, and minor account, and there was like nothing else besides that. So what I eventually decided to do was invest in my own name because I wanted flexibility. I wanted the ability to have that money if I need to. My children don't know that this money is invested with them in mind, but the flexibility for us was that we could access it, we can choose how it gets used and so forth. Um, Potentially I would do things differently now that there's more information. There's trust, you can technically invest through a super as well. There's other options, but at the time that was the best choice for me. And I think as my kids get older, that will evolve as well, because they're quite young. As they get older, I want them to be more involved. So that might move to a different kind of structure that potentially they have more access, that is actually in their name. They'll be the beneficiary in the future. But for now, that's what works for us.
Um, I've got one more question for you in a moment, but I'm hoping the community here can jump in with a few questions. So if you do have some, and you've got something on your mind, just bring it up right now. Even if it's more of a statement rather than a question, I'll take that. My final question for you was, practically doing the investing. That you don't have to get too bogged down like the legal or tax mechanics necessarily, but you mentioned bonds there for a second. That's something that's quite unique. What are some of the, I guess, opportunities for people? Like, what are the things that they could consider if they're going on this journey now? Just as a high level thing.
Yeah, yeah. So there's a couple different ways that you could potentially invest for your child. There's investing in your own name. There's investing through a minor account, or essentially a minor account, or it's informal trust. It's also what it's called. There's also investment bonds and education bonds, not to be confused with bonds that are on the share. There's a family trust, which I guess you maybe have talked about last week. And then the lesser known way is also investing through a super. And the potential is there in your own name or in your kid's name, depending on your age, your time horizon, their time horizon as well.
That's actually quite interesting because not many people do talk about that as a genuine option because they think it's so far for me, it's so far for kids. That's one of the things. So Rebecca says, I have trust accounts for each child and they have their own TFNs. I help them choose an ETF and they use their own saved money to buy their first stock and will continue to do so when they have enough. Rebecca, I would love to follow up with you, not to put you on the spot here, but how did you help them choose an ETF? I'm really interested in that. Um, Daniel did say, joined a bit late, but have multiple brokerage accounts, buy the AFIC shares regularly. That's a listed investment company that offers something called a share substitution plan, which is different to a DRP. These are all really interesting things. Question for you, Anna. If you were to start again, what would you have done anything differently?
I do appreciate some of the flexibility. Right now, where I am in my life, I'd maybe consider a family trust, and there's more reasons to why I would. At this point, I think also, I don't know, they're all great options, but it kind of depends on what you're looking for, right? An investment bond has some really great benefits as well because you don't have to. The tax consideration is slightly separate from your own taxable income, so there's the benefit there. And then there's also minor accounts that a lot of people consider because then that your child would be the beneficiary, as opposed to investing in my own way. So they're all great options. I think as my kids get older, the investments will change as well. For example, if my kid has their first job and they're setting up their super, there's the ability to maybe tap into the first home super saver scheme. And if that's a priority of my child, then that's something that you could potentially access through a super. So
Mm.
would I do things differently? I don't know. I'm really happy with the flexibility at the moment, but we'll see as my kids get older and more interested in investing. And right now, it's you can have a company, but they don't know much more than that at this
Yeah.
moment.
And I think that's a really good answer, and for the reason that a lot of people, when they set up kids investing strategies, they it's like they just go into this kind of like wormhole of tax, investment
Mm.
strategy, future planning, structures. It's just so many things to consider when you kind of just need to just pick one and you can change later on. Yeah, sure, there may be consequences, minor consequences from a tax perspective. But the flexibility is actually really important and you can change, or you can start down one path, let that go, and then start on another path in 6 years or 7 years. Like so many different options for people. Um, Now, before I say goodbye to you, I actually do want to ask you. You've written the book "Kids Ain't Cheap," but you've also co-authored another book. You co-host the podcast, the Get Rich Slow podcast, with Tash. You're on Instagram and all these types of things. Um, More of a how can people get in contact with you? How can people follow up? How can people learn more about you and what you're doing?
Yeah, great. You can find me on my website, or just it's probably easier to follow me on social under my name at Anna Kresina. And if you have any perler thoughts, you can reach out to me through the platform over there as well.
Yeah.
So happy to chat. Love talking about money, kids, investing, all of the above.
Yeah, great. I know you do a lot of speaking and that type of thing as well. So if you're watching this and you're in a workplace and you want to help your employees learn and discover, financial wellness, or how they can activate themselves for their family unit, get in touch with Anna because she's a wonderful speaker and resource. So, and I do apologize about my internet dropping out today. It
All
doesn't
good.
have it feels like it doesn't have that far to go from one side of Melbourne to the other, but I really do
I
appreciate
just kept talking, so hopefully I was engaging enough that people didn't drop off too much.
it.
Just kept going with the thing. So,
I like it.
thanks, Owen, for having me. It's always
Yeah.
a pleasure chatting with you.
Yeah, you're a natural, Anna. So thank you and enjoy the sunshine and have a wonderful rest of your day.
You too. Thanks.
So that was Anna Kresina, and she is available at this website. I'm just going to pop it in the chat. You can head there. You can get in touch with her on social media. You can grab a copy of her book. Honestly, grab it for yourself. Grab it for friends and family and those types of things. It's wonderful. So that's there. Now, I want to get a bit more into the weeds because I see some great questions have come through. So if you can still hear me loud and clear, I don't know what's going on with my internet today. I'm actually very humbled. I get to chat to the CEO of Aussie Broadband in a couple of weeks, and that's who we use for my internet. So I might just do a bit of troubleshooting live on air in a few weeks with the Aussie Broadband CEO. But I cannot recommend Aussie Broadband high enough. They are absolutely wonderful. Mr. Leftovers, any thoughts, any updates on the Self Wealth Takeover? I can dial into that towards the end of the show, and we can have a chat about that. But I do want to continue this chat about um, investing for kids because it's really important for me too. So thank you, Anna, also in the chat now. Thank you so much. So Let me just bring my slides back up. I wanted to explain maybe some of the stuff that other people really don't talk about that much when it comes to investing for kids. So I want to just cover off the basics. So investing for kids, this idea that like why is it a topic? Like why can't I just say to young Billy to go and create an account, right? Like just go and open an account. And the reason is under the law, it's very important to understand that when you buy shares, what you're actually buying is part ownership of a company. So you're buying part of a company, and so you are in effect a legal owner of a company. And a company, which you know, can do things like it can invest in property, it can employ people, it can do all different types of things. So by extension, you are investing in something which can create legal contracts and legal matters, employ people, and whatever. And now a child legally can't do that because under the law, until they reach a certain age, they don't have that capacity. They still need a parent or a guardian to take care of them. So it's the same with shares. They literally cannot open an account. Um, Now, there's also an additional layer of rules here in Australia. There's a few of them actually. But the second point I've got here is the brokerage rules. So, like if you open a Pearler account, Pearler's regulated by ASIC, which is the regulator, and they also have rules around all different types of things, money laundering, all different types of stuff. And so there's an additional layer on top. Um, the I'll jump straight down to the bottom one here. There's also a thing in Australia called unearned income. So you might remember last week, I'll just duplicate this, make it a little bit bigger so I can see a bit more. You might remember last week, we talked about the idea of having a family trust. So you might remember there was a trust in the middle, and this is where income can come into the trust, a legal trust, that's a T by the way, and then it can be split from there to, it can go to, parents, or it could go to kids, right? It could even go to a company that you set up that is what we call a bucket company or something like this. So we'll just put a big B under that. This family trust is a way to split income. Now, what would happen in times gone by is people that were savvy with finances, they would realize that if they had some sort of income from, say, shares, so I'll just draw a building so you know it's like the share market, right? If that's great. Like that would be grade 4 standard, I reckon. So if you have income from shares, in the past, not now, people would that income would come through, hit the trust, and then get split off to young Billy over here, right? Now, obviously, there would be in the past a tax advantage for that because if we took the parent might be earning $100,000 a year and paying tax at 30 or 40%, right? So for them to take the extra $5,000 in dividends or whatever they were receiving, they would be taxed very highly. But by splitting it with a child, they had this idea that, well, the child's not going to be taxed as much because they're not earning 100 grand, they're only earning 10 grand. So this is what we in the past called income splitting. And the ATO basically said, no, you're not allowed to do this. You're not allowed to use up a child's tax position as a way to lower your tax. It just doesn't make sense. So they brought in these rules called unearned income. And basically the idea is if the child's not actually working for their money, like you will get taxed severely. But there are other rules around kids and tax rates as well. There's multiple rules. And you can see just in general, kids are taxed very highly over here. So there's like from $0 to $416, for example, if they had money in their own bank account, they're not taxed. Over that, this is all from the ATO website, by the way. After that, until $1,300, they're taxed at 66% of everything over that amount, and then 45%. So they're taxed at the highest tax rate for anything over $1,300. So if you were in doing something, you would be taxed significantly by doing it that way. So there are alternatives to this, and there are ways that parents tend to go about it, as well as grandparents. You can still have family trusts set up. That's one of the options I wanted to talk to you about. You can still have this set up, but it's quite an expensive thing. It can cost you. I'm just going to say it's horses for courses, right? But I'm going to say it will cost you $1,500 to. I'm just spitballing here, guys. To say $3,000 a year. That would be quite expensive. I don't think it would be that much, but I just want to kind of set expectations. Now, to set up a trust, is going to be a cost involved with the accountant and that sort of stuff as well. If you do an extra layer like I have done, I have what's called a corporate trustee, which is where there's a company that administers the trust. And that's an additional layer of, tax returns and that sort of stuff. So Sparky said, for a family trust, it's great, but don't you need to make a certain income from the trust to make it worthwhile for the fees? Sorry, I have less knowledge of this. Yeah, so Sparky, you're correct. So that's where these fees comes in. It's like a self-managed super fund. So depending on the level of assets inside the child's account or what the parent and grandparents want to do, this may not make sense. And that's why in my email today, I said, for most people, this sort of thing is too complicated. But what most people do is they do something else. It looks and sounds like this, but it's not the same. So this is what we call, I'm just going to write it down so we can all see. This is called a family trust, right? So this is actual trust in law. So this is a big step. It's got a trust deed. This thing has to pay out the income every year. It's a different thing. Now I'm going to draw a line, and the stuff on this side is different. So you might have heard, I think I've written it up here. You might have heard of things like adult as trustee, or I think Anna referred to it as a minor account. So some brokerage platforms call these minor accounts. We also have these with Rask Invest. So on our platform, you can come in and I'll just show you what it looks like. I'll wait for that to load then. There we go. It's loaded. So on our platform, if you were to do this, I'll just show you what it looks like. Start a new one. Loading. All right, I should have loaded this in advance. But basically, let's choose a strategy, whatever. Down here, you can see that you can have all these different types of owners of an account. Now, this is just an example for us. You can do the same with all different types of platforms. But if you go to this minor tab here, you can see I want to invest as an individual on behalf of my child. Then you can have a joint parent account. Then you can have a joint trust individual. I want to invest as a family trust, e.g. John Smith as trustee for the family trust. And then you can say, if this would be my scenario down here, invest as trustee for the Smith family. So those are all the different options. But the most popular one that I see is this one. So this is where there's a parent that's holding the shares on behalf of the child. So that's this like this, and you can do this. It goes under different names, but some platforms call it minor accounts. Others call it as trustee for whatever, for child. But basically the parent owns the shares on behalf of the child. And this has benefits in that the parent is what we call the legal owner. So L is for legal owner, but they're held beneficially. So the beneficial owner is the child. So the child benefits from those shares or ETFs that you hold. The key thing is for people that consider this option is what happens when young Billy gets to 18. Well, when young Billy gets to 18, then they can take the legal ownership as well. And that's where you fill out a form, typically with your broker, and you transfer ownership. Now, I want to just cool everyone's jets here a bit because this is kind of free. It just all comes down to getting tax advice and setting it up properly with your broker. But I just want to make sure that people understand, rules can change and things can go wrong. Like these trusts have been around for centuries, this type of trust structure generally, like in the British law and that sort of stuff as well. This type of thing, I just want to make sure that people understand, like this can go wrong, and things can change with both. And so, eventually my view is that eventually like the ATO and the governments around the world will want everyone to pay tax regardless of whatever situation they're in. And we can see that already as a society, with more of society kind of bashing people up in the media just for having money. They think that, that's a bad thing, that people would have money and have more money than other people. And you can kind of see that. And that then tells politicians to change the rules and so on and so forth. So even though we talk about these, like this one's the cheap and easy option, and it kind of does the same thing as this one, there are different layers of regulation that sit around these. So I hope that makes sense. Andrew says, when will Perla allow CHESS-sponsored investing for children under their own TFN to avoid CGT later down the line? That's a good question, Andrew. I would chuck that through to the Perla support team. That might be something that's on their radar. So that's a good question. So you raise a good point about whose tax file number do you put down, right? So that's a really good point. Now, so Joe, you came up with something before which was really quite interesting. So I might open another slide here before. Obviously can't give personal advice in any fashion whatsoever on the show, but this was quite an interesting one, which I haven't heard many people talk about. So you say, hi, I'm investing for my kids via my self-managed super fund with the plan to give it to them when I am 60 plus and can withdraw it tax-free. Is this a good plan considering tax benefits? I can't, Joe, give you specific advice on this, but I'll just explain how superannuation works in a moment. And then you say, when my kids would be 25 and old enough to hopefully manage it. I think you meant to say responsibly at the end of that, but that's okay. So superannuation, I'll just draw a line and we'll say that this is retirement, right? So the way it works with superannuation is pretty straightforward. Is as you have your working life, which is on this side of the line, your assets through contributions and through market gyrations slowly goes up over time. Maybe there's a crash and then it comes back up and maybe it plateaus for a bit. And then you hit this magical line right here, which is called retirement. Now, with the superannuation rules is that once you hit this, you meet a condition of release and you are properly retired. So there's this kind of gray area between 60 and 65 that you should be aware of, as in everyone should be aware of these and know when their actual retirement is and how they actually do that. Your superannuation switches into something called pension phase or pension mode. So over on this side, we're accumulation. And you'll know this because if you go to your super fund and they say things like, you're in the accumulator strategy and you got the pension one. Right? And so basically, this is the moment when you start to draw income from superannuation. And the way the government set this up is that over time, you have to withdraw a certain amount of money from your super fund until eventually it should, in theory, reach a level where you pass away, whatever's left over here, that gets then either sent to your children or your next of kin or something like that as part of your will. But in this period of the blue line, there are certain tax rules, and you should look these up and speak to your accountant. But in many instances, it's tax-free, and you have to withdraw that money from superannuation. The government mandates a certain amount to come out. So if you kind of know these rules, there's potential that you could invest in a way, particularly as you get closer to super, to then use these rules to your advantage when you withdraw money. There are other rules in Australia which everyone should know about, like rules such as like the gifting rules and how you give money to someone, and whether or not there would be tax implications to that, and particularly if you're relying on Centrelink and those types of things. But there are very interesting rules, I would say, around gifting in Australia and how they can be to your advantage. And this is what we're seeing in Australia, in my opinion, quite a bit at the moment, is we're seeing older Australians that have reached retirement in this phase say, well, I might take some of my super, I might take a chunk out of it, like this bit right here, and I might turn that in, put that in my bank account and then gift it to my kids to buy their first home. And so this is what I was referring to earlier on about how people in general deal with the tax situation and managing their kids' affairs while helping them invest for the long term. So this is like putting your safety mask on first. If you're close to retirement or you're a grandparent, you might be able to use this knowledge to your advantage. Now, I don't want to say whether that's good or bad, but your accountant may be able to help you, or you may be able to do some extra reading on that. I just have to be careful with what I say. Raul, you've asked a great question. Thanks for joining us today, Raul. You said, If your parents had invested for you and you received $100,000 at 18 years of age, what would you have done with it? That's a good question for the group. If you got 18 years of, you were 18, everyone that's watching right now live, if you got 100 grand when you turned 18, what would you have done? I probably would have, I was investing around about that time. I probably would have bought a car and wasted my money on a car. I mean, it wouldn't have been a complete waste, but there would have been some element of wastage. But it probably would have been something like that. And I probably would have invested a little bit, or at least put it in a savings account. I think I'm going to show my age a bit here. When I was 18, I probably could have got 7% or more from the bank. So I would have thought that that's a pretty good return at the time. Had I known about shares, pardon me, I might have done something a bit different, of course. But I'd be interested in what everyone else would do. Travel for sure, says Anna. Something stupid, says Rebecca. Joe, you did mean responsibly. So coming back to this scenario here, this is something that I see is very common, by the way. I should mention this. So this is very common that parents, particularly in like Sydney and Melbourne, even Brisbane nowadays, Perth, well, basically everywhere, a lot of grandparents and parents are using their superannuation tactically for big moments in their child's lives. Now, is that the right thing to do? I don't know. In the UK, if it keeps going this way, I think what's going to happen is in the UK, you have estate taxes. So you could have someone with a very, very big super balance currently in Australia. So you could have someone with a huge super balance, and then they may be able to take money out because it's tax free and then gift it to someone because there aren't particular. I mean, there are some rules, let's be honest, go speak to your accountant, but they're not that many rules. Whereas in the UK, they have estate taxes and that sort of stuff, and there's a bunch of different rules. So it's a little bit different, but this is yes, somewhat interesting. Now, I wanted to go back here and tell you, where was it? How I'm investing for my kids, like how we have a family trust set up like this. And our approach right now is just to invest in our own names, but I've actually got a Google task reminder to call NAB straight after this because I'm just switching everything across to NAB at the moment to get a bank account set up for this structure. But we also have this structure where we've got a bucket company. It's not for everyone. Every company, every additional thing, it all sounds fancy, right, people? But every additional thing that you have set up costs money. So it's got to be reasonable. It's taken us years to get there. As I said last week with Alex on the chat, we've had this trust for years and it hasn't made any difference in our life other than costing us money for almost 10 years now. But now we're using it. And so that's one of the things. The shares that are held, you saw in Pearl for my sister, are legally in my name, and I just will cop the tax every time it comes through. But let's talk now a little bit about how I'd invest for a child. Let's just talk generally. I'll just clear this all out of the way. So I'm happy to answer questions on this, by the way, as we go through. Alfonso, is it automatic the kids get the shares at 18 years old, or can we hold it and give them to them when they're more mature? Yeah, sure. In the example that Raul, the hypothetical example that Raul wanted to test us with, that was just more hypothetical. But in reality, you don't have to give it to them when they turn 18. Some people may have a will, Alfonso, or some people may have in place, like what we call a testamentary trust. So let's say, for example, a parent dies or a grandparent dies and they leave money to their kids. In the will, it might say, when the money's going to the kids, but the kid can't take they can't own it, the money until their 18th or 21st birthday or something like that. That's where a good estate lawyer and a financial advisor works with parents and grandparents to set that up. But that's a unique case. But in the case of just people are still living, which is great, it's really up to the parents' discretion and grandparents' discretion. Now, in terms of investing for kids, I think a lot of people make a mistake in that they put the tax decision ahead of the actual investment decision. Of course, tax is a reality, but most of us on the call today probably don't sit here and go, my next investment is going to be Telstra because of tax. That's not what you think, right? Well, at least I hope you don't think that, because there's no point owning Telstra if it's a crappy investment. And there's no point owning something if it's not going to go up. Like if you've got an 18-year time horizon or a 20-year time horizon for the next generation, or even just your own investment portfolio, I can't imagine you would stop and be like, well, let's think about tax first. But for some reason, we try and do that with kids. It's a bizarre thing to me. The most important thing should be, is this a good investment and is it going to go up over the next 20 years? For me, that just seems to make logical sense. So I don't really overthink the whole first decision. I think more about the investments. And for me, there are a few things that I want. I want growth. And I'll explain that in just a moment. I want probably more growth and slightly less income. It doesn't need to be, that should be an L. Oh gosh, I failed primary school drawing. So less income, and then I probably want something called, that's another, I'm just going to stop doing H's and start doing L's. How about that? That's the new rule for today. Less H, more L. There we go. And I want what's called less turnover or lower turnover. That's not a U, that's a, oh my gosh. So there we go. Look at that. Passed with green colors. So growth, less income, less turnover. So what do these mean? So growth is obviously you just want I would want to choose an investment that goes up. It might go down, but the child for me would have long-term time horizons, so less emphasis on trying to preserve money like a retiree would. And I would do almost all shares. In fact, I would do all shares. I would just go all shares. So all shares. Like when I say shares, I also mean ETFs, right? I don't just mean an individual share, but I would do all shares. Less income. So this is an interesting thing. Joe, you've said, I think about tax as a way of maximizing my investment. Yeah, that's a great idea, Joe. I fully get that. In that, yeah, for sure. Tax is a real cost of investing and not enough people take account for it. Absolutely. And I think you know that about me too. I'm totally aboard that. But the thing is, if I had the choice of a 20% return and tax or a 10% return and no tax, I would take the 20% return every day of the week. So now I know I can't take into account your situation, but based on what you said before, you've obviously thought about those different things as well. So this is more for everyone else's benefit, just at a high level, just theoretically, how I think about it. So less income. The reason why I wouldn't want a lot of income is because every time there's income, there's potentially a slight tax event. Now, if there's franking credits, that helps to do things and whatever, but realistically, I just want less income. I would want to favor growth. Now, when people see this, they're like, okay, so more growth, less income, go for growth. Realistically, I'm going to bring something up for you. Credit Suisse Global Investment Returns Yearbook. So this thing here, which is going to download in my browser for just a second. I'll wait for it. Bada bing, bada boom. Okay, so this report is a wonderful report from Credit Suisse. And what it does is it analyzes all the stock markets in the world for their returns over more than 100 years. And people often get surprised by this, but look who's up here. We've got Australia, and if we look at Australia, where are you getting more mentions? One second. Australia. Come on. Show us the good stuff, Australia. Okay, here we go. As we show in Chapter 3, in common currency terms, US equities ranked second in the world after Australia. Suck on that, USA. Eat that, Donald Trump. Australia is the best performing stock market in the world. So, just think about that. Australia, best in the world. stock market, right? And people always rag on Australia like, oh, too much dividends, not enough growth. Ugh, give me a break. We are the best stock market in the world, even though we have income. But my point was going to be this, is that if you assume that the stock market, like, not saying that this is going to happen, but if you assume that the stock market was going to return 10%, some people say, oh, well, Owen, you're going to focus on more growth, you might get 12%. No, that's not how things work. As Warren Buffett once said, you can't get 9 women pregnant and try to have a baby in 1 month. That's not how investing works. If you just say, this is total return, so this is income plus growth. When I say growth, what I mean is don't change the actual number, just change what components go into it. So instead of, on average, say 6% growth plus 4% income, all I'm trying to do when I say more growth, less income is 8% growth plus 2% income. Because if I can get away with, blue, let's do that. If I can get away with 8% growth, which isn't taxed the same, that's a capital gains tax, CGT. Look at that, that's pretty neat. And this is income tax, income, IC. We'll just do that. If we can do this, it's the same total return, but the components of the return are different, which from an after-tax perspective may have benefits, if you feel me. So please don't be confused when I say growth at the and less income means more higher figure. If the reason I say this is people who try and target growth above all else make a big mistake. What they don't realize is that returns are not like linear. You can't just say, well, more return from more growth investing. It's not how it works. If you do that, you actually artificially expose your portfolio to way more risk. So in risk-adjusted terms, yeah, you might get a slightly bigger return 1 year, but the next year you might get a really negative return. So, statistically speaking, anything between like 7 and 11% is really good. And if you try and push beyond that, in my opinion, you're going to take a lot more risk, which may not be worth it for the slight bit of return you get. And a lot of people don't always understand that. So growth, less income because it's taxed slightly differently, and lower turnover. So turnover, what does that mean? Turnover is when you invest in something, like let's say you invest in an ETF. Let's put this up the top here. Oh my gosh, my writing skills are not good today. So inside an ETF, let's say you have the Vanguard ETF, the VAS ETF. So inside of that individual ETF, you will have hundreds of individual shares, right? And every time one share inside that ETF gets bought out, another one takes its place. And that's turning the portfolio over. So every time a new company enters the ASX 300, the VAS ETF will rebalance and it will create a buy and a sell event down the bottom here. Now, some ETFs are really diversified like this, and they don't do a lot of changing, which is really important because then it has low turnover. Now, if an ETF only has 10 positions, for example, I don't know, that's like 12, and one of the positions changes or two of the positions change, then all of a sudden 20% of the portfolio has been bought and sold, which creates tax. It creates CGT within the ETF itself. And so what you have is you have an ETF that's high turnover, creating taxable events. So that's why a lot of people that invest for kids go for share-focused ETFs that don't pay a lot of income, that also have low turnover from a tax perspective. This is probably more important to understand than whose tax file number is it. This is probably more important, but people tend to miss these points. So when I'm constructing a portfolio, this is what I think about. I don't really want bonds for my child. I will take bonds if they're like maybe 10% in bonds and cash, but I don't really want it. I can always get that somewhere else. I want less income and I want lower turnover. I also want lower fees. But I'm not as worried about that as I am with the return that I get as well. I know a lot of people are, but I'm not really as worried. So all those things combined, I think ETFs are a good solution. I don't think ETFs are perfect. Like, they're not the only thing that people should consider. I can't remember who it was. I said before, it was a wonderful comment. Daniel. Yeah, Daniel, you said AFIC, which is, in my opinion, AFIC, which is a listed investment company, it's not an ETF, is basically like the same as a VAS in terms of what they actually invest in. The difference is this is a company and this is an ETF, and a company doesn't have a turnover problem like this. It doesn't have this structure where it has to buy and sell things when the index changes, but it does pay tax. So as it goes, it pays tax. But it can pay franking credits. And with AFIC and Argo, there are very, 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 very unique tax rules that apply to them called a DSSP. DSSP, but basically means you can defer some of the tax and pay it as capital gains in the future, which is really interesting when you think about it. You can defer some of the tax and put it into a capital gain in the future. It's really quite interesting when you think about, I wonder if that would help with the child and planning. Interesting. But these types of things are suitable, in my opinion. Even things like diversified holding companies like Washington H. Soul Pattinson, not a listed investment company. Overseas investments, IVV, VAS, those types of things. Even just a diversified portfolio. So I mentioned that something like this, like an ETF with only 10 positions in it, would create more tax. But if the return was better than the tax that I would pay, then why wouldn't I go with that? And that's an example, maybe something like FANG over the last few years. FANG from GlobalX, full disclosure, GlobalX is a sponsor of our Australian Investors podcast. Not paid to say this in any way. But if you look at something like FANG, it's performed exceptionally well. Now, not to say that that's going to continue in the future. I definitely am not saying that. But people should be mindful that if you can get a great return, yeah, you might pay extra in fees. Yeah, you might pay extra in tax, but is it a better return? Graham says, I used to run our Australian share portfolio as mostly just growth. I now run it as mostly divvy, as in dividends, but with larger and more stable companies. Returns are the same, but less risky and less volatile. That's my point, Graham. Well done. Yeah, so exactly. So in finance, we have a really fancy word for that, or we do some math on that, Graham. It's called the Sharpe ratio. Sharpe ratio. SHARPE. Probably shouldn't have been named after him, but that's okay. The Sharpe ratio is basically a measure of how much return do you get for the amount of risk you're taking. And we measure risk in this instance by the volatility, the ups and downs. Oh, I just saw Ads comment. Thanks, Ads. Really appreciate your comments. The Sharpe ratio. Yeah. So the idea is that people think like risk is like something that it's not. It's not like going crazy for a return, because you actually ended up, if you, there's a point. This is like, imagine this point in somewhere out there in the world. If you step over that line, the moment that you step over that line trying to find a better return is the moment that you're going to get less of a return. So you kind of get to this point where it's like, you take any more risk and you're going to go backwards. But people don't think about that. They just think, oh, we'll just take more risk and get more return. It's not the way it works. So these are the types of things. I'm not saying any one of these things in particular, but these are the types of things I look for when I'm investing for kids. The reason I would use shares over cash is because cash is not going to grow for a child, especially after inflation, especially if the parent's paying tax on the interest that's earned. Just doesn't make any sense. I don't have enough money to go and buy my child a complete property, even if it was in my name. So that's not something that I would consider. So shares and ETFs make the most sense in my mind. I can always buy and sell them. Even if it means I'll pay tax in the future, I can always sell them. Now, just in the interest of time, we are going to do some more emails around and some more education around investing for kids. So if you're on the, not this website, if you're over on the Rask Media website or even on our Rask Education site, you will find more. This is not one, but if this is an example, you will find more education on our sites relating to kids and investing, particularly if you go under the education section. You click on guides here. we're going to bring more education in the next couple of weeks for people to learn about topics like this. So just as an FYI, if you're not already on the mailing list, just jump on the mailing list by creating a Rask account. It's free. Now, there was a question before. Wonderful question from where are you? Oh, updates on the self-wealth takeover. Yes, Mr. Leftovers, of course. I just wanted to check. I haven't checked it today. Let's have a look. I did write about this the other day. Becoming a substantial shareholder. So looks like there's no update here. Who is this? Becoming Harvest Lane. Oh yeah. So Harvest Lane here. If you just look at this is so context matters. Self-wealth is the subject of a takeover offer, and basically the two offers that are currently on the table are non-binding indicative, which means that there's absolutely no guarantee they're going to happen. Self-wealth is still a safe platform. It's still HIN-based. It's still all of those things you would love about it. So there's nothing changing in the immediate future. There was one from Bell Financial Group, BFG, not to be confused with Big Friendly Giant, which is some sort of book or movie that Drew was telling me about. It's Drew's birthday today, by the way, everyone. If you listen to the Australian Investors Podcast, feel free to say happy birthday to Drew. It's Drew's birthday. Also, they received another offer from Axie, which is a trading firm that does yucky CFD trading. So those are the two offers for self-wealth shares. So what we can see here is self-wealth shares are 25 cents each, right? So they're 25 cents each, which is interesting because the two offers that they've got so far were for 22 cents and for 23 cents. What that tells you, given that the share price is above that, it tells you that investors think a new offer is coming. So they think another offer is coming. Otherwise, they wouldn't have put it to 25 cents. I don't know if that's the case. I would suspect that might be the case, but we don't know. Now, Harvest Lane, the company that's just disclosed that it owns 5% of self-wealth, is what we call a merger arb fund. So what they do is when a company, in their particular example, Harvest Lane's strategy, is what they'll do is when a merger is announced or an acquisition is announced like this, once they see this happen, they'll go and do their research, and then they'll try and find companies or investors who are willing to sell them their shares, and they'll get in here in between this and this, and before the next offer comes, they'll try and buy shares of self-wealth in this example, knowing that another takeover offer could be about to come. So we call this merger arb. It's merger arb is this idea. I'll draw it for you so it might make sense to some of the more the different types of learners that we have watching. So say, for example, the first offer for self-wealth was at 23 cents. So this is 22 cents a share. The next offer might be at 23 cents a share, 23. Then Harvest Lane comes in here and buys shares, thinking that the next offer is going to be, say, 26 cents a share. And then what do they get from it? Well, they get this bit. They get this extra 3 cents. They take risk in buying shares at this time because the shares might not the company might not receive another takeover offer and it falls. But on the upside, they get this. And what ultimately happens for what we call a merger arb strategy, sorry to get in the weeds for people that were not interested in this today, but basically this is their upside if it goes to 26 cents, right? But on the downside, it might fall back to 12 cents. Or maybe even go further than that, 12 cents, which is probably like down here. So it might fall back to 12 cents if a deal doesn't go through, or it could go up to 26 cents if a deal does go through, and the current price is, well, at the time, let's say they bought it at 22 cents. So they can get this on the upside and this on the downside. Now, you're probably thinking, Owen, that looks interesting to me. What is actually happening? So what's actually happening here is you get this potential upside, but you get this potential downside, which is huge. So This type of strategy is not for people and not for investors who don't know what they're doing, because the downside is potentially bigger than the upside, right? And so if you don't know how to calculate these two probabilities correctly, what this is like picking up pennies in front of a steamroller. If your strategy is to merger arb or getting the arbitrage like this, that's what we call an arbitrage, you might lose more money than you make. The only way to be good at this is to have a really good understanding of the company that you're buying and whether another deal will come. Harvest Lane are pretty good at their job. So that's an interesting move. But that's merger arb in 2 minutes, and it's a very complicated strategy, but that's it boiled down into one chart. I hope that makes sense. In the meantime, what does this actually mean for human beings? Well, it's going to be interesting to see what happens with self-wealth. I would say that they're deep in discussions with these two parties, but maybe even others. And if I held shares, I mean, yeah, it's good news, because a lot of investors have been long suffering. Whether or not you bought shares up here, would you be happy about it? Probably not. Still better than 12 cents. If you're a user of self-wealth, I mean, it's not like you can just wait and see what happens. There's no alarm bells. But I wrote about it during the week. Let's see if it's here. You can read my articles on Rask Media, by the way, by going to this URL. I'm just pasting in here, and it shows you some of the running commentary, things like that. So that's it for this week. Have a guess what? Have a guess what's happening next week. Next week, something's happening. We are having a fund manager on the show. I think it's next week. Let me just check. I want to make sure before I stuff it up again. Yeah, it's next week. So next week on the Rask Invest live show, have a guess who we've got coming on. We've got Nathan Bell from Intelligent Investor. It's going to be heaps of fun. Nathan is easily one of the investors in Australia. Like, he would be in my top 3, potentially, definitely top 5 investors that I like to speak to in Australia. And he's coming next week. So he's in charge of the funds management at Intelligent Investor. Super interesting guy, really creative, really smart. So he's going to join us for Rask Invest Live next Thursday. So Nathan obviously specializes in both Aussie shares and global shares. So if you're a follower of Intelligent Investor, if you just like to ask experts questions like, how do you value shares? What do you look for? Like, what's your criteria? What's your checklist for finding companies? That's next week, next Thursday at midday. So come back next Thursday. In the meantime, you can head to the Rask Education company website. You will see, I'll just bring this up on the screen. We're starting to do something at Rask where the courses are going to be updated. We're going to bring more courses out. But one thing in particular we're going to do is, in the future, if you're stuck on our website and you think, I don't know what to do next, like I don't know which course or whatever, you will actually have the opportunity to book a call with one of our team. Sometimes it might even be me, to be honest. And you're like, hey, I don't know which course that I should do for this thing, or I don't know where to find that service. You can actually just book in a free chat, and they'll just tell you in like 5 or 10 minutes, these are the things that we do, this is how you can make use of it, so on and so forth. If you're a Rask Core member, you will see updates in the next week as well. So yeah, hope that helps folks. So thank you to everyone for joining today. Investing for kids is a great thing, in my opinion. Investing for your grandkids, even just putting yourself in a financial position where you can help your nieces or your nephews, is a wonderful thing. I often have this, I often grapple with this idea that I work in finance and I'm helping people grow wealthier when I could be out helping communities and doing all those types of things more actively day to day. But I know that our community is wonderful, and every extra dollar that we make as a community through our investing, through getting good jobs, through starting businesses, everything that we do as a community together, I know that everyone else then goes and helps other communities and sporting clubs, youth groups, whatever. So use that money that you have and use it consciously to support the community around you. And I think if you do that, it's a wonderful thing. It's a wonderful vocation to learn about investing and doing all that sort of stuff. Speaking of, actually, I want to show you one final thing, which you might be interested if you like that line of thinking. I put it out yesterday. We had this wonderful guest appearance yesterday here. This is Brian Hartzer, the former Westpac Bank CEO. Came out yesterday. We've already received some great feedback. If you want to learn more about like entrepreneurship, leadership, growing wealth, just everything like that, go and check out that wonderful episode. That's it for today, guys and gals. I'll be back next Thursday with Nathan. Don't forget you can get in contact with me via the Rask community, basically 24/7. I hope you enjoyed this show. If you want to have any follow-up questions on that, just drop them in the Rask community and I'll see you then. Okay, that is it for now. Thanks for hanging around a little bit of extra time.